Today we're plunging into a story that really shook the corporate world, often called India's Enron.
That's right, the Satyam scandal.
Exactly. And while, many people know the basic headline, Chairman Ramalinga Raju confessing to inflating profits by a huge 7,000 crore.
Which is just a staggering number in itself.
It really is. But our mission today isn't just about that headline. We want to unravel the real mechanics behind this massive fraud.
Yeah, get into the hidden depths. Because the deeper you look, the more complex it all gets.
We're going beyond the surface, uncovering those surprising, maybe lesser-known details of how it unfolded. We want to give you a shortcut to being, truly well-informed.
We'll be looking at who else was involved, the sheer scale of the deception, which went on for years. And those critical missteps, maybe systemic failures, that let it persist for so long before it all came crashing down.
Okay, so let's set the scene a bit. Before all this blew up, Satyam wasn't some small fish.
Oh, not at all. This was India's fourth largest IT company, a proper blue-chip firm.
Right alongside giants like TCS, Infosys, Wipro. It was a symbol of India's IT success story, really.
And its reach was enormous. Global footprint, listed on the New York Stock Exchange.
That's listed on the NYSE, yeah.
Operating in over 60 countries. You need to understand that context to really grasp the shockwave this sent.
Across the world, not just India.
Yeah.
Because people trusted this company.
Implicitly, many did. Which makes the betrayal even starker.
Now, here's where it gets really interesting, I think. The fraud almost got exposed, not because of auditors, but because of investors.
And the media, yeah. They started asking questions.
The tipping point, it seems, was Satyam's attempt to acquire two specific companies, Maytas Infra and Maytas Properties.
And the key thing here, these weren't just any companies. They were real estate businesses owned by Raju's own family.
Ah, okay. So the alarm bell started ringing immediately.
Instantly. The perception was, pretty clear. This looked like a desperate attempt to divert Satyam's legitimate cash.
To prop up these family businesses,
Yeah.
Right? To cover some kind of financial hole over there.
Exactly. Use Satyam's money to plug the gap in the Maytas companies. It raised huge red flags for investors.
So that failed deal basically forced his hand. It wasn't really about guilt or conscience suddenly kicking in.
Doesn't seem like it, no. His confession letter, that handwritten one in January 2009, that looks much more like a calculated move.
A preemptive strike.
Pretty much. He likely feared that the failed deal and the scrutiny it brought would inevitably expose the massive hole in Satyam's own books, the gap between the real cash and the fake profits.
So he tried to get ahead of the story, maybe control the narrative a bit.
That seems to be the consensus, yes, before it completely imploded on its own.
And speaking of control, let's be absolutely clear. Ramalinga Raju didn't orchestrate this alone.
No, definitely not. The sources point to at least 10 other key people being involved.
Including?
Well, his brother, Rama Raju, for one, the CFO, Vadlamani Srinivas, and, perhaps surprisingly, auditors from PricewaterhouseCoopers.
PwC auditors involved.
Okay, and even some independent directors on the board. It was quite a network.
The level of coordination needed for that is kind of mind-boggling.
It really is. We learned that the IT and finance teams inside Satyam were actively told to manipulate data.
Actively told.
Yeah, instructed to delete audit trails in real time, basically fudge the numbers continuously to match the fake bank statements they were creating.
So it wasn't just adjusting a spreadsheet at the end of the quarter. It was ongoing data sabotage.
Continuous, dynamic sabotage. That's a good way to put it.
And then there was the whole ghost employee thing. Over 10,000. That sounds almost unbelievable. How did that even work?
Well, they created thousands of fake employee records. This inflated the company's salary expenses on paper. Then the salaries for these non-existent employees were funneled into dummy bank accounts.
Controlled by Raju and his accomplices, presumably.
Exactly. Just siphoning money out through this phantom workforce. It was a major drain.
Which brings us to maybe the biggest question hanging over this whole thing. The auditors. PwC, how did they miss this for so long?
Yeah, that's the million-dollar question, isn't it? Or maybe $1 billion in this case. It seems to boil down to a fundamental failure in basic auditing.
Like what? What didn't they do?
The sources indicate they didn't do basic checks, like directly confirming bank balances with the banks themselves. Standard procedure, send a letter, get confirmation.
Did do that?
Apparently not consistently, or they relied on confirmations routed through Satyam. Instead, they seem to have just accepted forged documents and certificates provided by Satyam's own team.
Wow. Just took their word for it, essentially.
Relied on the client's potentially doctored evidence. A catastrophic oversight, really.
And this wasn't a short-term thing. You mentioned it went on for years.
Well,
when did it start?
The manipulation seems to have begun as early as 2001.
2001. And it wasn't caught until the confession in 2009.
That's right. Nearly a decade.
Almost 10 years of cooking the books. That's incredible persistence.
It really is. Fictitious profits were added methodically every single quarter. They used inflated invoices, those forged bank statements we mentioned.
Just kept layering it on.
Kept layering it on. And get this, they even managed to fool the Reserve Bank of India, the RBI.
India's central bank. How?
Satyam presented forged fixed deposit receipts and bank balances. And the RBI, along with several major Indian banks, apparently accepted them as genuine.
That shows how sophisticated the forgeries must have been.
It really does highlight the level of planning and, frankly, audacity involved.
So on paper, Raju looked incredibly wealthy, hundreds of crores. But it was mostly air.
Pretty much. An illusion built on a massively inflated, fictitious company valuation. Not real cash, not real assets for the most part.
Let's talk about the aftermath then. That confession letter in January 2009, you said it was calculated, but it was still a huge moment for corporate India, wasn't it?
Oh, absolutely huge. It was one of the very first times, maybe the first time, in Indian business history that a promoter, a major founder figure, openly admitted to fraud in writing.
That letter must have been crucial evidence later on.
Absolutely pivotal. It became a cornerstone of the investigations and really marked a turning point for corporate governance discussions in India. It forced a reckoning.
And the auditors, PwC, did they face real consequences? It often feels like auditors get a slap on the wrist.
Well, in this case, it was more than that. 2 senior PwC auditors were actually arrested and served jail time.
Really? Jail time for auditors?
Yes, which is highly unusual in India for external auditors to face criminal charges like that.
That sends a message.
And much later, in 2018, SEBI, the market regulator, banned PwC India from auditing listed companies for 2 years. Almost 9 years after the scandal broke, but still a significant penalty.
Now, you mentioned the Raju family. There were whispers, or maybe more than whispers, about political connections. Did that play a role?
The sources certainly suggest that. The family apparently has strong political ties, especially in Andhra Pradesh, where Satyam was based.
And the implication is?
The allegation is that these connections might have helped delay investigations or perhaps shield the fraud from scrutiny for years. It raises questions about systemic vulnerabilities,
How influence might create blind spots, or at least slow things down.
Exactly. An environment where maybe people felt less inclined to blow the whistle or investigate too deeply, perhaps.
And what about the board? The independent directors? These were often big names, respected academics, business leaders.
Right. And they largely claimed they had no idea. Complete ignorance of this massive fraud happening under their noses for years.
Which raises another fundamental question, doesn't it? About the effectiveness of independent directors.
It really does. If these highly qualified people didn't see it or couldn't see it, what does that say about their role? Were they truly independent? Were they asking the tough questions? Or was there too much trust in Raju and his management team?
It certainly challenges the whole concept of relying on independent oversight if it can fail so spectacularly.
It became a major point of debate after Satyam.
But despite this utter mess, the company itself didn't just vanish. There was a rescue.
Yes, and quite a remarkable one. The Indian government stepped in very quickly. They sacked the existing board, put in government-appointed directors to stabilize things.
And then looked for a buyer.
Exactly. They invited bids. Tech Mahindra, another major Indian IT player, won the bid and acquired a controlling stake.
And they rebranded it.
They rebranded it as Mahindra Satyam initially, and then fully merged it into Tech Mahindra in 2013. So the entity survived, albeit under new ownership and management.
A phoenix from the ashes, in a way.
In a corporate sense, yes. It showed that even after such a massive scandal, the underlying business or parts of it could be salvaged.
So, pulling this all together, what's the lasting impact? What's the legacy of Satyam?
Well, the most direct impact was on corporate governance rules in India. SEBI and the Ministry of Corporate Affairs really tightened things up.
Awesome.
Clause 49 of the listing agreement, which lays out governance rules for listed companies, was significantly revised and strengthened. Things like director responsibilities, disclosures, auditor accountability.
And you mentioned the auditors earlier. Any specific changes there?
Yes, a big one. The scandal directly led to the creation of the National Financial Reporting Authority, NFRA.
NFRA.
NFRA. It's an independent body specifically set up to oversee auditors and accounting firms, to monitor their quality and enforce standards, a direct response to the PwC failures in the Satyam case.
So trying to prevent another Satyam by watching the watchers more closely.
That's the idea, adding another layer of oversight specifically for auditors.
And the story itself, it kind of entered public consciousness, didn't it? Movies, TV shows.
Absolutely. It captured the public imagination. You see echoes of it or direct references in shows like The Whistleblower, I think on Sony Live.
Right.
And it got a mention in Scam 2003 as well. It became part of India's sort of corporate folklore, a cautionary tale.
So this deep dive, hopefully, has taken us beyond just that headline figure of 7,000 crore. We've seen the layers of deception, the systemic weaknesses, perhaps.
Definitely systemic weaknesses, and also the critical actions, like the failed Maytas deal and Raju's confession, that finally brought it all into the light.
And understanding a fraud this complex, it gives you real insights, doesn't it, into governance, the crucial role of auditors.
Absolutely. And the importance of due diligence, not just by auditors, but by investors too. And it highlights that connection between business, finance, sometimes politics.
It's a powerful lesson, really, in why transparency and accountability matter so much, even, or maybe especially, in the biggest companies.
Couldn't agree more. It's non-negotiable.
So as we wrap up, maybe a final thought for you, our listener, to chew on. We live in an age of incredibly fast technology, constant pressure for financial results.
The pressure's always there.
So what new ways, maybe more subtle ways, might corporate deception be happening right now under the surface? And what role do we all play, auditors, directors, even ordinary investors, in trying to spot and prevent the next Satyam?
That's the critical question, isn't it? Constant vigilance is key.